What is short-term investment? Short-term investments refer to financial assets that are held for a relatively brief period, typically ranging from a few months to a few years. These investments are often chosen for their ability to provide liquidity, preserve capital, and offer moderate returns within a shorter time frame compared to long-term investments. Short-term investments play a crucial role in a diversified investment portfolio for several reasons. Number 1, liquidity. They can be easily converted to cash without significant loss of value, making them ideal for meeting short-term financial needs or seizing investment opportunities. Second, risk management. Including short-term investments can help balance the risk profile of a portfolio, as they often have lower volatility compared to long-term assets like stocks. Third, flexibility. Short-term investments allow investors to react quickly to changes in market conditions or personal financial goals. You would be thinking, what is the typical time horizon for short-term investments? The time horizon for short-term investments typically spans from several months to a few years. This time frame aligns with short-term financial goals, such as saving for a down payment on a house, funding a vacation, or building an emergency fund. Unlike long-term investments, which are geared towards goals like retirement planning and wealth accumulation over decades, short-term investments focus on meeting near-term financial needs while preserving capital and generating modest returns. Overall, understanding short-term investments and their role in a diversified portfolio is essential for investors looking to manage risk, maintain liquidity, and achieve their financial objectives within a relatively short time frame. Section 2. What are various types of short-term investments? Short-term investments are generally categorized in following segments. Number 1. Cash equivalents. These include easily accessible and low-risk investments such as savings accounts, money market funds, and certificates of deposit (CDs). They offer liquidity and stability, making them suitable for short-term needs. Second, fixed income investments. This category comprises treasury bills, corporate bonds, and municipal bonds. These investments provide fixed returns over a defined period, making them attractive for short-term goals while offering slightly higher returns than cash equivalents. Third, stocks and equity-based investments. Some investors opt for short-term strategies in the stock market, like day trading and swing trading. These involve buying and selling stocks or other equity instruments within a short time frame to capitalize on price fluctuations. Each type of short-term investment has its characteristics and risk-return profiles, allowing investors to choose based on their financial goals, risk tolerance, and time horizon. Section 3. Let's delve into the risk and return profile of short-term investments. 3.1. Risk levels of short-term investments. Short-term investments vary in risk levels. Number 1. Low-risk options, like savings accounts and CDs, offer stability and minimal risk of losing principal. Number 2. Fixed income investments, such as bonds, carry slightly higher risk but still provide predictable returns. Number 3. Equity-based investments, including stocks and derivatives, come with higher risk due to market fluctuations and require active management. 3.2. Risk-reward trade-off. The relationship between risk and potential returns is fundamental in investing. Generally, investments with higher risk tend to offer the potential for higher returns, while lower-risk investments offer more modest returns. Investors must consider their risk tolerance and investment goals when choosing between different short-term investment options. A balanced approach involves weighing the potential rewards against the associated risks, ensuring that the investment aligns with one's financial objectives and risk appetite. Section 4. Let's explore the factors influencing short-term investments. Number 1. Economic conditions. Economic indicators play a significant role in shaping short-term investment decisions due to following reasons. First, interest rates. Changes in interest rates affect the cost of borrowing and the returns on fixed income investments. Higher interest rates can attract investors to bonds and other interest-bearing assets. Second, inflation. Inflation erodes purchasing power over time. Short-term investors may seek investments that outpace inflation to preserve the real value of their money. Third, GDP growth. Economic growth impacts corporate earnings and stock market performance, influencing short-term strategies in equities. Market trends. Market dynamics and trends also impact short-term investment strategies in following ways. 1. Volatility. Market volatility can create opportunities for short-term traders to capitalize on price fluctuations, but it also increases risk. 2. Trends. Identifying and following market trends can guide short-term investment decisions, such as entering or exiting positions based on market momentum. 3. News and events. Significant news, events, or geopolitical developments can trigger market movements, prompting short-term investors to adjust their strategies accordingly. By monitoring economic conditions, market trends, and relevant news, investors can make informed decisions and adapt their short-term investment strategies to capitalize on opportunities while managing risks. Section 5. Key considerations for short-term investors. Number 1. Investment goals. Setting clear and achievable investment goals is paramount for short-term investors. These goals may include 1. Capital preservation. Protecting the principal amount invested, especially for funds needed in the short term. 2. Income generation. Seeking investments that provide regular income streams, such as dividend-paying stocks or interest-bearing bonds. 3. Capital appreciation. Pursuing opportunities for growth and capital appreciation, albeit with higher risk, to achieve specific financial objectives. By aligning investment choices with their goals, investors can tailor their portfolios to meet their short-term financial needs effectively. Number 2. Liquidity needs. Short-term investments are preferred for funds needed in the near future due to their liquidity, which refers to the ease of converting investments into cash without significant loss of value. Key points regarding liquidity include 1. Emergency funds. Having readily accessible funds in short-term investments ensures financial security during unexpected expenses or emergencies. 2. Opportunity seizing. Liquidity enables investors to capitalize on time-sensitive opportunities or market conditions, such as buying undervalued assets or participating in limited-time offers. 3. Flexibility. Short-term investments provide flexibility in adjusting investment strategies based on changing financial goals or market conditions. The importance of liquidity underscores the role of short-term investments in meeting immediate financial obligations and seizing opportunities as they arise. Section 6. Short-term investment strategies. Number 1. Diversification. Diversification involves spreading investments across various asset classes to reduce risk. In short-term investing, diversification can be achieved by allocating funds to cash equivalents, provide stability and liquidity. Fixed income investments offer predictable returns. Equities provide growth potential but with higher volatility. Diversification helps manage risk because losses in one asset class may be offset by gains in another. It's a fundamental strategy for balancing risk and potential returns in short-term portfolios. Number 2. Timing strategies. Timing strategies focus on when to buy or sell investments. Two common timing strategies are: Number 1. Dollar cost averaging. Investing a fixed amount at regular intervals, e.g. monthly, regardless of market conditions. This strategy reduces the impact of market volatility by spreading investment purchases over time. Number 2. Market timing. Attempting to predict market movements to buy low and sell high. While successful market timing can lead to significant gains, it's challenging and risky due to market unpredictability. Pros and cons of timing strategies. Pros. Dollar cost averaging reduces the risk of investing a lump sum at a market peak. Market timing, if successful, can lead to higher returns. Cons. Dollar cost averaging may result in missed opportunities during market rallies. Market timing requires accurate predictions, which is difficult to achieve consistently. Both strategies have merits and drawbacks, and investors should consider their risk tolerance and investment goals when choosing a timing strategy. Next section, Section 7. Monitoring and reviewing investments. Regularly monitoring short-term investments is crucial for evaluating performance and comparing it against investment goals, along with identifying changes in market conditions that may warrant adjustments to the investment strategy, ensuring investments remain aligned with financial objectives and risk tolerance, and seizing opportunities or mitigating risks as they arise. Tax implications. Taxes can impact short-term investment returns in following ways. 1. Capital gains taxes. Profits from selling investments held for less than a year are typically taxed at higher short-term capital gains rates. 2. Interest income taxation. Interest earned from investments like bonds or savings accounts is subject to income tax, affecting overall returns. Short-term investments are essential components of a well-balanced investment portfolio. They offer liquidity, capital preservation, and moderate returns, catering to various financial goals within a relatively short time frame.